For 30 years, Japan had the cheapest money on earth. So why is the country with the world's lowest interest rates now at the center of a global bond shock? In early 2026, the 30-year Japanese government bond yield exploded to 3.91%, the highest since that bond was created in 1999. The 40-year yield broke above 4.2%, a record, and the move did not stay in Tokyo. US 30-year Treasury yields jumped toward 4.9% the same week. Japan is the single largest foreign owner of US debt, about $1.2 trillion. So the real question, when the world's anchor of cheap money starts to lift, who else gets pulled up with it? First, what lit the fuse? New Prime Minister Sanae Takaichi won on a promise to break from austerity, tax cuts plus higher defense spending, a stimulus package near 21 trillion yen. To bond investors, that means more borrowing, and they demanded a higher yield to fund it. And Japan starts from the worst debt position in the developed world. Government debt above 230% of GDP, more than double the United States. For decades, that debt was financed at almost zero cost. That is the part that is now changing. Here is the mechanism. For years, investors borrowed yen at near zero rates, converted it, and bought higher-yielding assets all over the world. Think of cheap yen as the foundation under a very tall building of global leverage, estimated in the hundreds of billions of dollars. Now the foundation is moving. As Japanese yields rise, Japanese money has a reason to come home instead of chasing returns abroad. And because Japan is the largest foreign holder of US Treasuries, money leaving America's bond market pushes US yields up too. So here is the disconnect. This looks like a Japanese fiscal story, a Tokyo problem. But the world's lowest rates were the price anchor for global money. When that anchor lifts, the carry trade reverses, and the largest foreign creditor pulls capital back. A local problem becomes everyone's bond problem. What would break this thesis? The easy take is that this is just another UK trust-style panic that quickly reverses. But analysts at Capital Economics argue the opposite, that this is Japan's structural new normal, not a one-off. So watch two things: whether the Bank of Japan steps back in to cap long yields, and whether Takaichi's spending plans actually pass. One last thing. The yields, the debt ratios, and the Treasury holdings here come from public market data and government filings. The framing, why Tokyo's problem becomes a global one, is analysis, not a recommendation. Verify the numbers before you draw conclusions.